Hey there, welcome to another edition of TokStocks. I'm your host, Keir Reynolds, and today we're here to catch up with Sean Black, CEO of Happy Belly Food Group, trades on the CSE with the ticker HBFG. How you doing today, Sean?
Great, Keir. Thanks for having me. Been a while.
Yeah, thanks for coming back. We spoke sort of last quarter. You got your Q3 sort of out here, I guess, about a month ago. And just thought it'd be good for us to do kind of a year-end wrap-up. You guys have had an extremely busy year, and just for those of my viewers that sort of watch this, since the beginning of the year, you're up over 400% your share price. That's not taking into account highs. That's just Jan 2nd to today, intraday trading. So pretty healthy, and the stock's up about just over 130% since we last chatted. So if anybody sort of decided to listen and purchase some shares, they're probably pretty happy with you and probably interested in what you have going on. So anyways, why don't we get our 60-second stock pitch out of the way, and then we can jump into things. Sound good?
Absolutely. Yeah, absolutely. Sounds great.
All right. First question. What is the name and stock ticker of the company?
The name is Happy Belly Food Group. HBFG is the ticker in Canada. HBFGF is the ticker in the US. Trades on the Canadian Exchange, CNDX. The ticker company is based out of Vancouver, and office is in Oakville, Ontario.
What's the vision of the company?
We are a consolidator of emerging brands, emerging food brands, both typically, heavily predominantly, I should say, in QSR, but we still look for emerging brands as well in CPG when and if we could find them.
Approximately how many shares are outstanding?
Today, about 125 million shares are outstanding.
And approximately what is the insider ownership?
Recently, when we were checking this, we went from 2% when I first joined, and we just surpassed 25% insider ownership as of last quarter.
Are you fully funded for the coming year?
Yes, we are very well funded.
What are a couple of short-term catalysts that we should be watching out for?
You know what? If I was recommending investors, follow our financials. Follow the fins quarter over quarter. I think in 2025, the biggest catalyst that we have will be our financials.
Approximately what is your market cap today?
Today, we're about $150 million market cap. Canadian.
Excellent. Thanks so much for going through that. So for those of my viewers that haven't watched one of our 6 or 7 videos before, maybe you could just give a little background on yourself. Who are you? How'd you get to where you are today?
Okay, thank you. Started in the restaurant business when I was 14. Grew up just outside of Ottawa. Opened my first restaurant when I was 19. Grew that, sold it. Had an opportunity to catch early in the PETA wave and the healthy eating. Came across a brand, Extreme PETA. Started as a franchisee, became a partner in the parent company, grew that brand to about 100 stores. We then launched a brand, another fast casual brand in Canada called Mucho Burrito. We were early in the fast casual Mexican. As an emerging brand, built those two brands to just over 300 restaurants, plus pipeline. We were close to 400. Sold that to MTY. Post that time, I became part of the management team at MTY as their chief development officer. We built that after my period of time was done. We went out and launched another company called Crave It Restaurant Group. Two of the more prominent ones in that, those banners were Burgers Priest and Fresh Plant Powered out of Toronto. We grew those brands with behind the scenes. We had Recipe, which is Fairfax, as our partners. We built those to very profitable numbers and vended them in the summer of 21 to Recipe and Fairfax. And then since then, we came across this company, small one called Plant & Co. Over time, we moved away from plant, became a little more agnostic to the food business, more diversified, changed the name to Happy Belly Food Group. And if you look at the history, today we're 9 QSR brands and 2 CPG brands. And that's in about 3 years that we've assembled those brands. And we are going to continue to consolidate as we move into 2025.
Excellent. Well, you answered what was going to be my next question, which is how many brands do you have? So you got 9 on the QSR and 2 on the CPG.
Yes.
You kind of mentioned earlier, as a catalyst in our little 60-second clip that financials are something to sort of watch out for. Maybe you could kind of comment on your Q3 financials. I thought they were fairly impressive. And when I compared it, over sort of a comparative sort of period, you guys have been maintaining, if not growing margin, which is, I guess some people are a little kind of concerned in an inflationary environment where they're hearing some things related to sort of the food industry. Looked like you guys were doing well in terms of maintaining that sort of margin, healthy margin overall. But what are some highlights for you in terms of your Q3 financials?
We look at a few things. That was our 10th record quarter in a row from disciplined growth. To your point, yes, margins have improved both, bottom line and top line. And in our business today, if your restaurants are, specifically are improving their food costs and improving their, efficiencies and labor costs, that's a pretty good place to be today, which, in a lot of markets, there are some pressures out there for sure. So, we have a healthy balance sheet as of last quarter, I believe $3.5 million, and, we're probably closer to $4 million once we close the next financing that'll close shortly here. The burn is down significantly. We have with our significant pipeline that we have in the restaurants, which are asset light for the most part. We expect to accelerate that significantly post Q3, Q4, and Q1 of 2025. One thing people have to watch out for is we did close the IQ Foods acquisition with only about 12 days of earnings, I believe, in our Q3. So that'll be a catalyst on its own, which will appear in our Q4 financials. So when I say look at, the financials, I realize they're trailing, but they're a pretty good indicator of what's to come.
Yeah, you were approaching profitability. I think you in the quarter sort of net lost about 160 grand, if I'm not mistaken. So that's certainly showing some sort of good improvement, and that's across, again, a diverse set of businesses, some corporate stores, some franchisee, some QSR, some CPG. So
that's right.
Pretty impressive.
And we brought on some great people in there. So during that time, we've increased headcount, but to provide the quality and level of support that we expect. So, and our franchisees expect. So, we're positioned for growth, and Q3 was just a further indicator of execution.
So I think a lot of investors, when they hear about this company, they really know who the Seans are. You and Sean, your COO, who used to be CEO. Mm-hmm. But in terms of, you mentioned headcount, approximately how many people sort of, kind of work for, sort of head office or kind of for the parent co, Happy Belly?
I think we're about 10 staff today, which is up from, to your point, I think there was 2.5 of us a couple of years ago. So we have added some key people, but, senior leadership, like meaningful people, like everybody we hire, has to be able to have an immediate impact and move the needle. We're not in a position where we're going to hire somebody and, hope to see, the fruits of the labor in 12 or 24 months once they get trained up. So, we've added some great people. If you look at John DeLutis was with us from store number 17 in Mucho Burrito up until, recently he built that brand to 150 units and incredible brand vice president. So John has joined us in a similar capacity as overseeing some of the QSR brands that we have across Canada. Randall Papineau joined us. He was previously the COO and lead person for Fresh Restaurants, a plant-based chain that we had previously. So he's got, extensive experience and, a great disciplined operator in the business. So yeah, we are continuing to add to our bench strength, and, headcount will continue to grow as we scale the business, as well as we both organically and inorganically. If we bring on any more M&A, we will look to increase headcount.
Excellent. And as mentioned, I guess last summer, it saw you sort of jump into the CEO seat. How are you enjoying your new role?
You know what? It's been a lot of fun, actually. I would say the hardest part going into this was, Sean was the founder. So very much his company and his vision to that point. Him and his family being by far the largest shareholders. Always an interesting one. You never want to step on toes or do anything, but at the end of the day, I believe everybody in management has the single focus of, doing right by shareholders and building a real business here. So, with that commitment from Sean and his support, it's been a lot of fun and it's been great. And we have just accelerated the business dramatically from that time.
What's one thing that might be a little bit different from expectations of the role?
Well, before, I guess the easy part is if anything goes wrong, just blame it on Sean. The other Sean, the other, the other
The
Sean,
other shot.
it's always his fault. You know what I mean? So, now it's probably, I might get, blamed more often than him. But you know what, making, some of the decisions, but first off, I try to work day to day and say best decision wins, best idea wins always. And at the end of the day, we share in the responsibility of making those decisions, but it's been a lot of fun. And I think that, people have embraced it. Our staff and our team, and I think, so has the investment community. I think, I was certainly, I'd say always behind Sean and pushing and supporting. So now I think we're just doing it together. And, for anybody that's watched the show, Billions, which, I love that show. Sean is, for sure in my phone and in the office, he's Wags. So he is, he is that guy and he gets everything done. There's nothing he can't do. And he is, I'm going to say 20 hours a day, 7 days a week. He is pedaling hard. He may look like a bit of a duck, from above the water, but I guarantee you under the water, his feet are moving fast. And, he's busted his butt for the franchisees and for our shareholders.
Awesome. And how many locations now total between corporate and franchised are open across your brand portfolio?
40 stores open as we speak. We have an M&A closing imminently with nine locations. Plus with a few more opens, we will shortly be over 50 stores. And, total pipeline today is, about 421 stores. So, we have an active, I think we're close to 14 restaurants currently under construction as we speak. So, Q1 with openings, Q4 is already our biggest quarter we ever had for openings. And, just based on what's under construction, Q1 is going to be like multiples higher than 2024. So Q1 2025 from a new growth standpoint is really setting the bar high. We're raising the bar.
And in terms of, so you've got about 40 that are open and operational now. There's another 11 or so, through I guess two additional store openings, and then 9 that you're sort of acquiring in a deal. But of the 40, can you give us sort of an approximate split between sort of corporate, owned and operated, and franchised?
Yeah, today we have 8 corporate stores in operation, and we anticipate that number to increase in 2025. If you look for an overall on a go forward, I would anticipate about 10% of all openings that we do will be corporate and about 90% franchised. As the free cash flow increases on our brands, we look to reinvest that free cash flow into more corporate stores.
And I was going to ask how many are currently under construction. It sounded like 14 is the number.
14 currently. And we got a significant amount more coming in 2025 and Q1 that are going to enter construction. We have several that have now all start construction in, I'm going to say Feb 1st. I think we have 3 or 4 more that are going to start in February.
And what would be sort of the top brands in terms of total store count? Out of that 40, which are the brands that represent most of those?
Via Chibo today would be, from a standpoint, probably from sales and footprint, it's, as it approaches 10 stores. Up there you have Heel, which is now approaching 20 units open. Rosie's is, today 4 stores, but, on its way to 10 here imminently in 2025. Yolks is expanding. IQ Foods is expanding. So, like I said, I think we have, it's 4 or 5 locations that start construction February. And so, plus the ones we already have on construction, we expect to deliver like significant system sales growth in 2025.
Excellent. And which brands are you kind of, I know you wouldn't have any, you can't necessarily say you have any favorites, but which ones are you kind of most focused on, or is the corporation sort of most focused on sort of ramping up and scaling?
Well, from a free cash flow standpoint, within the brands, Rosie's and Heel today are in a position where they can be reinvesting and opening more corporate stores in parallel to significant franchisee pipeline. So those probably have hit that, those 2 brands today have hit that inflection point where they are accelerating growth significantly. I'm going to say Via Chibo as well has now got some franchise pipeline, so that's moving forward. And Yolks is moving to a very unique situation with Quebec growing, Ontario and Alberta and BC. So I think it'll be also by the end of 2025, it'll be also a free cash flow machine by the time we get to the end of the year.
And which provinces are you kind of most focused on for sort of expansion?
Short term, it's Ontario, Alberta, and BC. We would expect to add in those provinces alone, with total growth between organic and inorganic, 30 to 50 units in 2025.
Any restaurants that you'll ever open in Kelowna?
Yes, actually. We've got significant interest for Yolks, Heel, and Rosie's in Kelowna already. So we are actively working on real estate and with franchisees. It's, when the right opportunities come up from the right landlords, we'll move on. But yes, we'll try and get something closer to you for sure.
Well, we certainly love our smash burgers out here, and there's not that many, so competition's low. But I think you guys would do really well. And
yeah, BC
on the smoothie side, well, we'd certainly could use some assistance there. So look forward to a first Heel opening at some point.
Yeah, absolutely. We've definitely been. I just came back from BC, actively looking at real estate for Yolks expansion, Rosie's expansion, and Heel expansion. So those brands are actively growing in BC as we speak.
In terms of profitability, do you guys have you said anything? Do you have anything sort of projected in terms of profitability? When you become profitable, that would obviously open you up to additional sort of screeners and investors that would probably have to stick you into their portfolio based upon hitting that metric. Again, have you guys made any sort of like formal sort of guidance on that, or is that just
we haven't publicly stated? We haven't publicly stated, but to your point, yes, you nailed it, Keir. Like, there's one key metric left for us that I've been meeting for the last, not 3 quarters. The demand and interest from institutional has grown significantly. Not all of them, but some of them have one key metric left that they're looking for. I believe before some of the larger funds in the country that want exposure to the food space come in, and that's what they call earnings per share positive. That seems to be the last one of the holy grail that they're all looking for. And we have a clear line of sight on when we believe that'll happen. But, when it does, that's when I think the support from institutions will, grow significantly. So I think people that have been paying attention, just my own assumptions, but, you've seen the share price go up. You've seen our daily trading volume go up significantly. When you and I first started this, if we were probably 15 cents, 13 cents, something like that. And if we traded 100,000 shares that day, which, would have been a total dollar value of 13 to 15 cents, we were getting phone calls saying, well, is there news coming? There must be a leak. Like, your volume's up so much. And I'm thinking, wow, now you're getting days,
yeah,
$500,000 to $1 million worth of, shares trading. And,
Yeah, I
Nobody's,
think we were joking back. I think we were joking back then, and I think you were more like 8 or 10 cents when you first got going with it. So,
yeah,
but still, we were joking that your stock price would close in the green if you just could trade more than 200,000 shares in a day.
yeah. It's funny, you know
Now,
what? People just say that,
now you're doing
yeah,
that in the first hour. So,
yeah, and,
um,
and the dollar value has changed, right? You know, an type
yeah,
of investor that's buying. So, do I think some people are seeing some clear indication based on our numbers? Plus, looking forward to the amount of stores that are opening. Some of them are probably getting in front of or I believe, probably getting in front of the institutions, and they're probably saying, you know what, I'm going to build my position, and then when they come knocking, I'll sell my shares to them.
So let's move into a couple of investor questions. I posed a couple of questions on X there, or ask people to submit them. So we have a few. So
Sure.
bear with me. We've got a few. You're a more popular story, so we got a few more inquiries. Can you comment on U.S. expansion? I know there was some mention of it sort of before, and I certainly understand that, you know, if you're cooking, literally cooking in Canada, and Canada is very different than the U.S. market, um, then maybe you should stay within Canada. But anyways, what's the comment there in terms of like future U.S. expansion?
We are actively looking. Peel, we've announced the deal for an LOI for the first 10 stores. So we are actively looking for real estate in the United States for that brand. And when and where we get the right deal, are we going to move on it? Yes, we will. Like, you know, I'm actively working with the real estate team in the U.S. and you know, there's no rush from our standpoint. To your comment, like we also don't want to go a mile wide and an inch deep. We're trying to go in every category we're in every market we're in. We're trying to go a mile deep. And so with the right partner at the right time, we'll do those deals. You know, we are even now fielding a ton of inbound inquiries for M&A in the United States. So, you know, I've spent some time down there recently. We'll continue to do the belly check on product, people, product, and process. And you know what, we're open to organic growth or inorganic growth in the United States when the time's right. So as soon as we can update the shareholders on something like that, you know, I look forward to it. We're just disciplined though. Like, you know, not going to do anything just to appease the shareholder.
Sure.
You know, we want to appease the bottom line, not the news line.
Another investor question. Is there any more CPG? Are there any more CPG acquisitions that you guys are looking at or would consider? So outside of your QSR sort of focus, you've got your two CPG brands. Would you do you have any in the pipeline? Are you looking at some? Is that something that you're still interested in growing?
You know what? It's a category that we have the bench strength to do, but return on invested capital so far from the deals that I see that come across our desk, it's just not there. Like I don't see the numbers making sense based on, you know, if we could buy brands today between 1 and 6 times EBITDA on the, you know, on a growth brand in CPG, will we buy them? Yes, we will. But if you know, today, most, you know, people come to us and say, well, I want 1 or 2 times sales. And I'm like, but they don't even have a bottom line. So, it wouldn't, so far what I've seen, it wouldn't be disciplined and it wouldn't fit our model. So are we open to doing business on M&A in CPG? Yes, we are. If anybody sees one out there that watches this, you know, clip and can send us a profitable CPG willing to sell based on a reasonable multiple of EBITDA, we are active buyers.
Another question. Are you guys experiencing any sort of impact related to the HST holiday? What's your sort of stance on the whole thing, and how are your different brands navigating that?
Yeah, absolutely. You know, I mean, it was something that, you know, everyone had to prepare for and, you know, update their, you know, POSs and, you know, have your IT team on so that, you know, customers were getting the benefit at store level. So, you know, we definitely had to prepare for it. It's something that we are actively offering. And, you know, I can't say it's had a positive or negative impact yet in the store level. I think it's too early till you see the sales and how this rinses out. But I think the consumers that can take advantage of it do appreciate it. And I know you know, we've been out there doing some Christmas shopping. You know, people are certainly offering, you know, educating customers on what's covered, what's included, what's not included. So, hey, everybody gets an opportunity to save $1, they're going to do it.
Next question. This comes from Paulie B, which you might follow there. He always comments and has some great questions. He's curious. Maybe he's considering buying a store, getting into the restaurant biz. He's curious, how profitable are the franchise owners, and what are the costs to set up versus sort of anticipated revenues? Are there any sort of metrics that you kind of look for?
Yeah, exactly. So our brands today, typically our entry point is somewhere between, probably the cheapest one we see out there is 100,000, and you probably see some as high as 800,000-900,000. It's probably the range that we play in, and that'd be more along the lines of a yoke, so that the higher, bigger footprint stores, down to a heel. I mean, you might open one for 100,000. So they do range, in costs. Typically, if anybody out there today is looking to buy a franchise, what I would tell them is, the minimum number you look for is from sales to CapEx. So whatever it costs you to open, you're looking for a minimum number of 2 times sales. That's a minimum. If, when you start to see brands that do 3 to 5 times sales to CapEx, then you get, real interest in. If you find stuff that does 5 to 10 times, they're probably going to be one of the most lucrative, sought after franchises in the food space in the world.
So just for example, if you were looking at 500,000 CapEx to get it open, you're looking for a minimum of about $1 million. So about 2 times that initial setup in terms of gross sales that would be needed. And then if you're able to get, 5 or 10 times that, that would be extremely healthy and highly sought after and probably pretty competitive.
Absolutely. 3 to 5 is really, really good. Anything over 5 is, you're starting to reach unicorn status.
Excellent. Well, I think that's helpful for people. Last question here, investor question. Has inflation become an issue yet for any of your franchisees? We hear a lot about consumer spending is tightening due to inflationary pressures. We hear a lot about sort of food costs. How are Happy Bellies sort of navigating it? And when you can maybe just comment on that.
Sure. Yeah, for the most part, we're experiencing very healthy same-store sales across the board. Our chains are up year over year, and some of that is probably, some inflation pressures and some dying down happening out there. I think people are probably visiting a Rosie's or an A&W or, versus, going to, I'm going to say a Kelsey's, like they may be spending a little less on the full serve and a little more on QSR. And the sweet spot that we play in, I think, gets a little less pressure than, say a Tim Hortons. I think sometimes the Tim Hortons consumer might be a little more price conscious than, people, shopping in fast casual. So I think there's pricing pressure every single day in the business, whether it's your taxes to your property or your cleaning or your maintenance or, your lettuce that comes through the door. So it's a battle every single day to make sure you drive food and labor costs. We are certainly able to do that when we, even in its example, IQ Foods, since we've closed on it, we've been able to implement changes and improve labor, improve food costs. Purchasing has changed dramatically. So we're able to, enhance the EBITDA in the most part for our brands, but it's a reality of business today, to be, chasing costs and pressure every day.
What's an average Rosie's burger sort of go for in Ontario?
If you look, most of the stuff on the menu, you're going to spend between, $8 and $15. It's probably the average one. By the time I come out of there with a pudding and, a double cheeseburger and a few things, it's probably pushing the price point to, $20-25. But, I'm full and happy and, it's I can't help but go there.
Excellent. Good stuff. Thanks for answering those. Maybe, so you've done a little bit sort of on franchise education. You already answered a bit of a question in terms of sales to CapEx, what you should sort of look for. I guess with Happy Belly, being so successful, up a 10x over the last 2 years and up over 400% so far this year. starting to trade volume and get on a lot of people's radar screen, you've also started to get a few kind of copycat or people that are like, hey, if I pull franchising into my business model, maybe I can
Yep.
survive too. So what's some of the jargon that investors might want to like look out for related to companies that bring the term franchise into their business model?
Twofold. I would say, main thing I'll go back to is people, product, and process, right? Anybody can do just about anything, but how well they do it, or how well the brands perform, that's different. Can we do in the next month, 10 M&A deals and buy a bunch of crappy brands? Yes, we could. You know what I mean? Is there lots of people out there to hire that won't move the needle? Yes, there are. You know what I mean? So I think every company still boils down to your people. If you the quality of people that are running the business. I think if you look at our team and the resume and track record, including, right from top to bottom, from Gary to Sean to John DeLutis to Randall to, Alex, Mark, everybody that's in here, Kevin, everybody here has a track record of success in this business. And everyone is, working hard to replicate that at an accelerated pace. So I think you still got to look at I tell people all the time, before you invest in our company, do me a favor, go do the belly check, go try the food. 'Cause if you don't like the food, then why would you invest? Because you don't believe in brands. And same with franchising. Guys say, well, I want to buy it. I heard it's popular. Have you been to the restaurants? No, but I'm going to go soon. Do me a favor, call us back after you've been to the restaurants. And I think that's the biggest selling feature, even for landlords. We're getting real estate and securing stuff like, when we did recently with Shops at Don Mills or, high profile spaces in, Alberta, BC. It's because the landlords want the brands. We have a track record of success and always paying our rent, which helps. And then so the relationships with the landlords, that's part of the people answer. Then they try the brands and they love it. So, at the end of the day, you're not seeing us today showing up at franchise shows everywhere. People are buying these brands because of the people, the product, and the numbers. And the unit economics at the restaurant level for us are very successful. So they sell themselves.
So could one assume that if, let's say if you're putting $150,000 into a heel location, that it would generate in excess of $300,000 in annual sales in the first year of business?
Yeah, before we get into too many disclosure issues, but yes, like we don't have any stores doing those sales. You know what I mean? So, our store sales that brand has incredible unit economics. We love it. And we will continue to open them corporately and franchise that brand in parallel in 2025. I would expect Heel to, say it exits around 20 stores this year. That brand alone should add, 15 to 20 stores in 2025. So it's beyond its inflection point. It's very cash flow positive, and it's accelerating top line and bottom line with our foot on the gas in 2025.
Excellent. And just a question for you. You're looking for your opinion. For example, you've got Heel or you've got Rosie's. You've got some of these chains which are quickly, building great brands. Would you ever sort of see, a CPG play, or, where you'd sort of look to sell products that are related to that brand in a traditional sort of grocery store? Or is that something that, might be overly competitive to the franchisees?
Yeah, I'm not a huge fan of anybody that goes out and sells their core product and becomes a direct competitor franchisee. Like, I actually don't understand, CPG guys saying, or QSR brand, so you leverage your franchisees' advertising dollars and off their backs and you can build this brand. And then you take it and you put that same product, their core product, into their backyards and you become their biggest competitor. So am I a fan of that? No, I think that's a terrible business model. And if I was a franchisee, I'd be pissed if a franchisor ever became my biggest competitor. So do I understand when the Keg puts some of their spice or some of their non-core items in grocery? Yeah, for them, I'd say that's worked out pretty well. But is that something that we want to do? No. I'd rather take one of our brands that we own on the CPG side that has nothing to do with it and then sell that through our QSR. Or take our QSR brand products, non-core items, and then sell them across. But if you look at, a strategy that Brookfield deploys, I think it's great. I think they start to do linear integration with some of their products and their services. So when they buy something, then they sell it within their own store. So over time, as the next phase of our company, not only are we going to start consolidating categories, I'd like to see us acquire some assets that we can then use to vend in. So why wouldn't we want to provide our restaurants with our own, I don't care, flour, our own, I'm going to call it seeds, anything that goes into, a core product that goes into our brands that could be sold across multiple brands. We are very open to buying that brand or that manufacturer while supplying our own stores. There's been some companies that have done that very well, but that's because we're the built-in end user. So I don't mind owning the producer when we can, because I already have the customer base, which is our own stores. That I love. But if I saw a franchisor selling and competing, in store, I think it's a failed business model. And I'm surprised anybody would ever buy a franchise from that model. I don't get it.
And in terms of like percentage sort of split between, what sort of percentage of, I guess, sales that a franchisee sort of would do, what's sort of considered like healthy for a franchisor to like receive in terms of a stream back? And is there ever a time when you could be, when a franchisor could have fees that are too high? Maybe you could comment a bit on that.
Yeah, I think there's a couple ways on that. I think there's some franchisors out there that do it interesting, where they make, a really high royalty, but then they also make money on the real estate. So some of them charge percentage of sales as well. So, Tim Hortons, I'm going to say, and McDonald's have probably been, people still say McDonald's is more of a real estate company than it is a burger company, right? So, the healthier your system is, and your franchisee's P&L is, then the more the companies actually work. So the more they can reinvest into their staff and their team and into their, refurbishing their restaurants or whatever. So it's for sure a balancing act. I think most brands out there, between 5 and 9% is what you see on a royalty basis. We charge 5%. And today we're very comfortable with that. And, we're making sure that the old saying where everybody at the table gets to eat. And we certainly want that for our franchisees. So we're not trying to, start out at 9%. Just when people say, well, why do you charge 9%? Well, because we can. I don't think that's a great answer.
In terms of, how much time or how much energy, or is it becoming a growing item having to, consult or work with franchisees to make sure they're successful? Is there time that's having to go into that, or are you guys more working with more proven groups that, this ain't their first rodeo and they don't really need any help sort of operating a business? Maybe you could just comment on that.
Yeah, if you look at some of our franchisees, they've become, they come from very successful franchise backgrounds, whether that's been with Mucho Burrito or A&W or, some of the larger brands in the country. It certainly helps if you have to, you support one franchisee that owns 10 or 20 stores versus 20 franchisees, because it's just more time consuming. So from a time standpoint, yes, that is easier. They typically are well-resourced, well-funded, so there's advantages to that. The other side of it is if a bunch of people own one store each, they probably, treat that thing like a little baby and take care of it. And, they might work their market better than somebody that owns 10 or 20. So there is trade-offs to both sides. But certainly for us, we have a lot of experienced franchisees that are acquiring stores from us. I think a lot of them just, first off, the unit economics are better than what other franchisors might be able to offer them today. And as well, I think because of our approach, which is pretty hands-on and our guys are in the field, and there's a reason why we added John and Randall to our bench strength. That's the difference. So because we're at a point of over-supporting and making sure people are, getting off the ground right, that's important to us. So I think that's attractive to our brand.
Yeah, excellent. Any sort of let's wrap up. Any sort of like last thoughts that you kind of want to leave us with? Anything you want to say?
Yeah, to your point, like, people say, oh, your share price has, ran a lot and it's up a lot. And I would say too, in my opinion, I got asked that a lot when I was in Montreal the last couple of days. My answer was, well, the results speak for themselves as far as the results we've achieved in the business. And even though our share price is up, I believe the business is doing better than our share price. I think it's, that's the underlying piece. The underlying assets are performing better than our share price. And I think team is executing, and we're just setting up for significant growth in 2025. So, we're not here to, we didn't join here to get this to $1.25. Like, that was never the end goal. And we're having a lot of fun. We've got a great team, and I say it all the time, but we are just getting started. So 2024 was a foundational year, in my opinion, with people, product, and process. We've got that in place. And I think now 2025, like, the seeds that we've been planting for a long time now are starting to come through the grass. So you're turning into grass. They're starting to come through the ground. So people, I think, as more people can touch and feel our restaurants in 2025, when we have a much bigger footprint open, if we're able to go from 50, not long ago, we were at one restaurant. Now we'll be at 50, on our way to 80 to 100. As soon as we show that, I think, not only will our potential franchisee base grow, but so will our investor pool, grow to the point all those little things are coming together at the same time. And we're well funded. So, don't be looking for any, dirty financing that gets dropped on, overnight, and it's a 20% discount with, full warrant, and it has everybody upset. Like, that's not who we are. We're disciplined operators. We're well funded by, institutions and funds across the country. So we just got to execute, and I think the reason why our share price is where it is because we are executing, and people believe that we can execute at a high level for a long period of time going forward. So, Rolex is more expensive than a Citizen watch, and there's a reason why.
Hey, there you go. Could you comment, is there anybody else that's, any other franchisors that are sort of growing more aggressively than you guys that you're aware of in the country?
Yeah, you know what? If you look at Blackstone and a couple of the groups out there, I was going to say there's been, I'd say the most aggressive one out there today is private equity. The amount of private equity calls and people trying to enter the space is significant. So from a public company standpoint, I don't think anybody in Canada has been as acquisitive as we have and added, as many brands as we have in the last 2 years. MTY has been pretty quiet. Foodtastic has done some deals. They're private. But QSR in Canada, QSR hasn't done the M&A, but Recipe has been very quiet. So, I think we are from an acquisition standpoint, we are probably the most aggressive, publicly listed company in the country. But we're also disciplined. Like, we prefer not to overpay. And if you look at the deal size that we typically do, I read an article this morning in BNN, and I shared it with a few people. Like, I thought it was excellent because it highlighted the risks to some of these bigger deals over the last several years with high debt and high leverage. And I think people that have went out and spent $200, $300, $400, $500 million, and with the majority of that in debt. And then, what happens if you buy it and then it closes some stores? Or what happens if their sales slow down and you're highly leveraged on that asset? Well, then the amount of free cash flow it puts out is brutal. The downside risk is huge. So I think for us, the other day, like, let's say we're around $200,000 of secured debt on the company total. When our direct competitors are somewhere between $500 and $900 million on their balance sheet, I think we're able to be nimble. We're able to deliver more organic growth. We're able to stay more disciplined because we don't need to buy more just to grow. We can grow organically without doing any M&A. So, and set record quarters after record quarter. So it doesn't, we're in a very good situation where we will be rewarded for a clean balance sheet and disciplined growth. I believe in 24, 25, and 26. That's our goal. We want to be known as that operator that gets to the point where we're returning a significant amount of cash to our shareholders versus just servicing debt at the bank. Anybody that's today with a heavy debt balance sheet and not delivering, positive same-store sales and not delivering significant organic growth, I believe that's a tough spot to be in. So I'm very comfortable with where we are, and we just look to accelerate inorganic and organic in 2025.
Hey, Sean, well, that's great. I think we'll leave it there. Thank you very much for the update. Wish you and your family a Merry Christmas and
Yeah, you too.
Happy New Year, and enjoy maybe just a couple days at home there before I know
Yeah,
you're back
well, I
on the
got
road.
2 p.m. suggesting I take a couple days off. You know what I mean? And we're going to be working. It's amazing. I've already had many calls booked for Monday, and I was really surprised. I thought people would want to take it off, but it seems mostly on the fund and the institutional side, there's people still doing some homework and probably working from home and putting some work in and stuff like that. So we have some calls next week and some stuff, but I will enjoy some time with my family. And, I certainly recommend, hopefully you get to do the same. And then we once Christmas is over, we enter the new year. Yes, I have some, significant travel coming in, Q1. But it's because we have our foot down on growth. So we're not done for the year. I tell you that. I've got meetings today, meetings tomorrow, meetings Monday, and I'll be in restaurants on the weekend. So we'll take a couple of days off, but we want to, the work we're putting in today will bear fruit in 2025.
Hey, excellent. Thank you so much. Have a great rest of your day. Thanks, Sean.
Yes, sir. Thank you, Keir.